Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is titled Financial Services Tax Developments in India. By way of introduction, my name is Russell Gaitonde and I am your host for today. I'm a tax partner based in Deloitte India's Mumbai office and I serve as the Financial Services Tax Leader for Deloitte India. Joining me today for the webcast are my fellow tax partners Rajesh Gandhi, Madhav Kanhare, and Behroz Kamdin, all from Deloitte India's Mumbai office. Rajesh Gandhi leads Deloitte India's FPI practice and works extensively with FPI and AIF clients. Madhav Kanhare works extensively with private equity, sovereign wealth funds, and foreign pension fund clients. And Behroz Kamdin is the insurance sector tax leader for Deloitte India and works extensively with insurance clients. You can access our profiles at the left-hand corner of the screen. Before we start with the topic for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. All users are on listen-only mode. If you have any questions, you can submit at any time in the Q&A box at the bottom of your screen. We'll do our best to respond to your questions during presentation or thereafter. We will have an interactive session and we'll seek your response on polling questions during the webcast. You may download your CPE certificate immediately following the webcast by clicking the Request CPE icon at the bottom of the webcast console. We now move on to today's agenda. We will be discussing developments for eligible sovereign wealth funds and foreign pension funds, fintechs and sustainability-linked lending from the IFSC GIFT City in India, developments for asset management in IFSC GIFT City, recent audit trends in private equity, developments in insurance and reinsurance, and we will conclude with a Q&A session. As you will note from the topics for today, there have been significant changes in the Indian tax and regulatory landscape that impact clients in the asset management, insurance, and fintech spaces. The regulatory and tax reforms hinge around the government's ambition to develop the new International Financial Services Center in GIFT City in India into a truly global financial services center akin to Singapore, Hong Kong, London, and Dubai. In its first phase of growth, we anticipate the IFSC GIFT City providing international financial services to cater predominantly to the needs of the Indian economy, and subsequently in a second phase, growing into a truly global financial services center. IFSC GIFT City is a special economic zone, and as its name suggests, it is dedicated to financial services businesses. All businesses that are set up in the GIFT City are awarded various fiscal benefits, the key being a 100% income tax deduction for a period of 10 consecutive years spanning across a block of 15 years, a reduced minimum alternative tax liability of 9%, indirect tax benefits, and stamp duty exemptions. These will be covered in greater detail by Rajesh and Behroz as applicable to asset management and insurance and reinsurance. All financial services activities that are conducted in the GIFT City come within the regulatory purview of the IFSC authority, and all businesses set up operations in the IFSC GIFT City need to be licensed and regulated with the IFSC authority. The IFSC authority issues various regulations, notifications, and circulars to govern the activities within the IFSC GIFT City. We will now commence our session for today with a discussion on the developments for sovereign wealth funds and foreign pension funds, fintechs, and sustainability-linked lending. Coming to sovereign wealth funds and foreign pension funds. As you would be aware, to attract long-term finance from sovereign wealth funds and foreign pension funds towards Indian infrastructure projects, in 2020, the Indian government introduced a specific provision in the Indian domestic tax law, that is section 1023 FE, to allow such eligible investors to claim income tax exemption in India on any dividends, interest, and long-term capital gains that they would realize from their investments made in qualifying Indian infrastructure projects. This is subject to satisfaction of various conditions, including the sovereign wealth fund or foreign pension fund getting itself notified by the central government for such income tax exemption purposes. Key conditions stipulated include that the investment is to be made during the period April 1, 2020 to 31st of March, 2024, that the investment is held for a minimum period of 3 years, and that the investment is made in a SEBI-registered InvIT or an Indian company that is carrying on the business of developing, operating, and maintaining qualifying infrastructure projects in India. or an Indian holding company that is set up on or after April 1, 2021, and having a minimum 75% investments in one or more qualifying infrastructure projects in India, or an NBFC that is registered with the Reserve Bank of India as an infrastructure finance company and having a minimum 90% lending to one or more enterprises that are engaged in qualifying infrastructure projects in India, or a SEBI-registered Category 1 or Category 2 AIF that has a minimum of 50% investment in one or more of the aforesaid entities. There are several conditions that the sovereign wealth fund and foreign pension fund need to satisfy to qualify for getting notified by the central government for income tax exemption purposes under Section 1023 FE. Thus far, the Indian government has granted around 24 notifications to sovereign wealth funds and foreign pension funds and their wholly owned subsidiary entities. There were several ambiguities present in the aforesaid Indian income tax law relating to income tax exemption that is available to eligible sovereign wealth funds and foreign pension funds, which the Indian government has tried to clarify over the years and continues to do so. Earlier this month, the Central Board of Direct Taxes have issued a set of new guidelines providing important clarifications as regards how the aforesaid income tax exemption is to be granted to eligible sovereign wealth funds and foreign pension funds. First and foremost, the condition that the investment made by the sovereign wealth funds and foreign pension funds in qualifying infrastructure projects in India needs to be held for a minimum period of 3 years is to be satisfied not only at the sovereign wealth fund and foreign pension fund level, but also at the qualifying investment level. Else, the dividend, interest, and long-term capital gains earned from such investments, whether past, present, and future, will become taxable in the hands of the sovereign wealth fund and pension fund. For past income earned and claimed as income tax exempt, it becomes taxable in the year of non-compliance. This is particularly relevant in situations where the sovereign wealth fund and foreign pension fund is invested in an Indian AIF or an Indian holding company or an Indian NBFC, and such entity has used the funds raised from the sovereign wealth fund or pension fund to onward invest or lend to a qualifying infrastructure project in India, and where such Indian AIF or holding company or NBFC divests its investment, whether partially or fully, in the Indian infrastructure entity or project within the aforesaid 3 years period. Secondly, in a positive development, the Central Board of Direct Taxes have clarified that investments made by eligible sovereign wealth funds and foreign pension funds in an eligible infrastructure entity that is on any other businesses as well, whether made directly or indirectly through a holding company or an alternative investment or an NBFC, will also qualify for a proportionate income tax exemption subject to the profits before tax of the eligible infrastructure entity from qualifying infrastructure projects being 50% or more of total business profits of the eligible infrastructure entity. Thirdly, in another positive development, the Central Board of Direct Taxes have clarified that where an eligible sovereign wealth fund and foreign pension fund has invested in an Indian AIF or holding company or NBFC, and subsequently such entity does not satisfy the prescribed 50%, 75%, or 90% conditions for investments to be made in qualifying infrastructure projects, then the sovereign wealth fund or foreign pension fund will not be penalized for income tax exemptions claimed on income emanating from such investments. However, present and future incomes earned from such investments will be ineligible for the income tax exemption. Fourth, the Central Board of Direct Taxes have clarified that non-compliance with any of the conditions of Section 1023 FE or the associated rules and notifications will disentitle the sovereign wealth fund or foreign pension fund from claiming income tax exemption in the year of claim. However, certain specified minor non-compliances, such as not getting accounts audited or not providing audit report in the specified format or not maintaining segmental accounts of income and expenditure in respect of qualifying investments, will not suo motu disentitle the sovereign wealth fund from the income tax exemption claim. Fifth, in yet another positive development, the Central Board of Direct Taxes have clarified that since Section 1020 FE has been introduced in the statute books to promote investments in eligible infrastructure projects and InvITs, secondary acquisitions in existing qualifying investments will also be eligible for income tax exemption. This clarification has been a long pending ask of the sovereign wealth fund and foreign pension fund industry. Next, in another welcome development, the Central Board of Direct Taxes have clarified that since the notified sovereign wealth fund or pension fund have large-scale global operations, out of which the investments in India might be a significantly lower portion, the annual certificate to be provided by the sovereign wealth fund or foreign pension fund from an Indian chartered accounting firm in the specified Form 10 BBC and the quarterly statement of investments to be provided by the sovereign wealth fund in foreign pension fund in the prescribed Form 2 of Form 10 BBB needs to be submitted only for Indian investments made by them, both eligible and illegible investment, and not for the global operations of the sovereign wealth fund or foreign pension fund. This is subject to the sovereign wealth fund or foreign pension fund maintaining separate accounts with respect to its Indian investments and foreign investments, and segmental accounts of income and expenditure in respect of eligible investments which qualify for income tax exemptions. There is also a new reporting to be done by Indian holding companies, AIFs and NBFCs to help the CBDT track how capital is raised from sovereign wealth funds and foreign pension funds and how it's deployed into qualifying infrastructure projects. As you will note, most of the aforesaid developments are progressive in nature and will be welcomed by sovereign wealth funds and foreign pension funds as they help provide clarity and certainty. I think the important point to keep in mind is that the compliances also have increased, and clients should focus on how these reportings are done to the Central Board of Direct Taxes. Now, quickly coming to fintechs and sustainable lending. On the topic of fintechs, to grow the fintech ecosystem in India, the IFSC authorities have recently issued a framework for fintech entities to set up operations in the GIFT City and have also provided them with the requisite innovation sandbox, regulatory sandbox, and interoperable regulatory sandbox environments. Fintech entities that set up operations in GIFT City will be able to claim the various fiscal benefits that I talked about earlier and which are applicable to all businesses that are set up in GIFT City. They will need to get themselves licensed and regulated by the IFSC authorities, and both domestic fintech entities as well as foreign fintech entities qualify for registration under this window. The authorities have also launched FinTech Incentive Scheme 2022, through which they propose to establish a world-class FinTech hub and propose to give various grants to FinTech entities that operate out of the GIFT City. On the topic of sustainable lending, to encourage greater sustainable and sustainability-linked lending by financial institutions that are based in the GIFT City, the IFSC authorities have, in April 2022, issued the guidance framework for such lending by banking units, finance companies, and financial units that are located in GIFT City. Per the guidance framework, all such financial institutions need to develop a comprehensive board-approved policy on green, social, sustainable, and sustainability-linked lending by 31st of March 2023. Starting April 1, 2023, all such financial institutions shall have at least 5% of their gross loans and advances directly made in green, social, sustainable, and sustainability-linked sectors. In case the financial institution is unable to meet the above objectives, it shall report the same to the IFSC authorities and explain why there are such non-compliances and what is their plan of action to ensure the compliance in the near future. With this, we have come to the end of our session on developments for sovereign wealth funds, foreign pension funds, and fintechs, and sustainability-linked lending. Keeping with the theme of GIFT City, I would like to invite my partner Rajesh Gandhi to speak with us on the developments for asset management in IFSC GIFT City. Over to you, Rajesh.
Thank you, Russell, and good morning and good afternoon to all our listeners, and thank you for joining in. Today, I will briefly talk about the alternate investment fund framework in mainland India, as well as the new regime for AIFs in the GIFT City, which is India's first International Financial Services Center, or IFSC, set up in the western state of Gujarat. But first, as I said, let's talk about AIFs in India. As you can see, this slide shows the typical AIF framework and the taxability of AIFs in India. AIF is a structure which is set up in India for the purpose of pooling money and making investments in portfolio companies, private as well as public. AIFs can be formed as a company, limited liability partnership, or a trust, although the trust structure is the most prevalent for AIFs in India. There can be three categories of AIFs. Category 1 AIFs are venture capital funds, which primarily invest in startups or early stage ventures, small and medium enterprises, or other socially and economically desirable sectors. Category 2 AIF is like a residual category, akin to a private equity fund for investment primarily in unlisted companies. And Cat 3 AIFs invest mostly in listed securities and derivatives. These are generally long-only funds or long-short funds. And unlike Cat 1 and Cat 2, Cat 3 AIFs can also employ leverage within an overall cap of 2:1. There are close to about 1,000 AIFs in India with a total commitment of about $85 billion, and 80% of the commitments have been made in Cat 2 AIFs. An AIF needs to have a sponsor, a trustee, and an investment manager, all based in India. The investment manager can be an individual, company, or a LLP. The sponsor contribution or the skin in the game can be provided by the sponsor or the investment manager. Coming to the taxability of AIFs, Cat 1 and Cat 2 AIFs have been generally given a pass-through status under the income tax law. Hence, these are tax transparent entities, and any income earned by a Cat 1 or Cat 2 AIF is taxable directly in the hands of investors. However, if the AIF earns any business income, then the same is taxed in the hands of the AIF itself and not in the hands of investors. Investors of Cat 1 and Cat 2 AIFs are eligible to claim treaty benefits as well as foreign tax credits. Unfortunately, there is no specific provision so far for Category 3 AIFs, or rather taxation of Cat 3 AIFs. Accordingly, we have to apply the generic taxation principles applicable to a trust where the AIF is set up as a trust. Practically, we have seen that most of the Cat 3 AIFs pay tax at the AIF level itself, in which case the investors are not liable to tax in India. In terms of tax rates, these are generally similar to those applicable to other investors. And unlike an FPI, one disadvantage of using an AIF structure is that there is no certainty on classification of income for AIFs, and income from sale of securities can be taxed as either business income or capital gains, depending on facts. Interestingly, the Indian indirect share transfer provisions do not apply to Cat 1 and 2 AIFs, but no exemption has been given to Cat 3 AIFs. Also, from a US investor point of view, an AIF which is set up as a trust or a LLP is generally treated as a foreign partnership for US tax purposes. Let's move on to the next slide and talk about AIFs in GIFT City, as Russell mentioned earlier. The IFSC authorities have recently notified new regulations for fund managers and investment vehicles to be set up in the IFSC. The new regulations are called the IFSCA Fund Management Regulations 2022 and will be effective 2 days later, which is from May 19th, 2022. One of the key features of this new regulation is that the authorities will now regulate and issue licenses to fund managers instead of funds, unlike what happens with AIFs in mainland India. And this new regulation is in line with global best practice in many other countries. Once the fund manager obtains a regulatory license, the fund manager can launch various investment vehicles without the need to obtain a separate license for each vehicle. The other feature is that the fund manager can now undertake a host of fund management activities relating to either retail schemes, non-retail schemes, PMS activities, family offices, ETFs, etc., all under a unified license. Another feature of the new regulation is that the registration of fund managers will be based on a risk-based approach, somewhat similar to the FPI regulations. Fund managers pooling money from accredited or other large investors and making venture capital investments will be subject to the lowest regulatory oversight as compared to fund managers pooling money from retail investors. Let's move to the next slide and deep dive a little bit more into the regulations. There are three categories of licenses which can be obtained by the fund management entity, or FME as we can call them in short. The first one is the authorized FME license. This is for fund managers which pool money from accredited investors or other large investors and make venture capital investments. Second one is the registered FME non-retail license. This is for managers which pool money for making listed or unlisted investments, somewhat similar to an AIF. And the third category is the registered FME retail license. This is for fund managers which pool money from retail investors or small investors like a mutual fund. As you can see from this slide, detailed guidelines have been issued for each of these three categories in terms of the schemes which can be launched, the different entity types, what is the minimum ticket size for investors, minimum net worth for fund managers, which is a new requirement, and the requirement for having directors and key managerial personnel. Interestingly, while AIFs in mainland India have several restrictions on undertaking leverage, co-investments, and making overseas investments abroad, funds launched in the IFSC have greater flexibility in undertaking leverage as well as having co-investment structures, which makes the IFSC framework very flexible and attractive for different kinds of structures. IFSC funds, which have Indian resident investors, can also freely invest in foreign securities without any limit. One more important clarification issued under the new regulations is that the schemes launched by these fund management entities will be regarded as respective AIF category for taxation purposes. Therefore, depending on the investment objective, the schemes will be categorized as category 1, 2, or 3 AIFs, and the taxability of such schemes will accordingly follow. For example, if the FME sets up a fund for investing mostly in listed securities, or the fund employs diverse or complex trading strategies, then the fund will qualify as a Cat 3 AIF. In such a case, all kinds of capital gains derived by such fund, whether from investing in securities in India, securities in the IFSC exchange, or foreign securities, will be completely exempt from tax, except capital gains from sale of Indian shares. Let's move on to the next slide. The new regulations also provide for a framework for schemes to be launched in the IFSC. As you can see from the slide, there are 3 types of schemes which can be launched: venture capital schemes, restricted schemes for non-retail investors, and retail schemes. Guidelines have been issued in respect of minimum and maximum corpus of the fund, number of investors, as well as skin in the game requirements. Note that the maximum skin in the game contribution from the investment manager cannot exceed 10% of the fund corpus. This seems to have been done primarily to ensure that Indian money does not get reinvested back into India through our IFSC fund. IFSC authorities have also issued a separate framework for other kinds of funds like special situation funds, ETFs, ESGs, PMS, and family offices. However, we will not cover all of this in detail today. Moving on to the next slide. Setting up a fund in IFSC as compared to offshore jurisdictions, for investing foreign money into India can provide certain additional benefits. In other words, let's look at what benefits a fund in the IFSC could have as compared to having a fund offshore. Firstly, capital gains on non-equity investments such as bonds and derivatives are exempt for a restricted scheme like a Cat 3 AIF, as I mentioned earlier. This is in line with the benefit under India's tax treaties with most of the popular jurisdictions such as Singapore, Mauritius, Cyprus, etc. Also, dividend and interest income enjoy a concessional tax rate of 10%, and no tax is payable in respect of income earned from foreign securities. Foreign investors investing in such funds are also not required to obtain a tax registration or file a tax return in India, so they can completely be insulated from Indian compliance requirements. Another important aspect is that since entities in IFSC are regarded as residents in India for tax purposes, the question of claiming treaty benefit does not arise, and arguably the provisions relating to domestic anti-avoidance rules and the principal purpose test under the OECD BEPS MLI would not have to be complied with by IFSC funds, providing much needed tax certainty to them. Also, management fees earned by the fund management entity would be exempt from tax for 10 consecutive years out of 15 years, with the ability to avoid even the 9% MAT. So you could have zero corporate tax and zero AMT. Apart from savings in stamp duties, no GST is levied on management fees and other business income earned by the fund management entity, resulting in savings of the 18% GST. There can also be moderate to high savings in operating costs as compared to running a fund in a foreign jurisdiction. Let's move on to the next slide, and I would like to wind up the discussion with a brief mention about the VCC or the proposed VCC regime in the IFSC. This regime has not yet been codified by the IFSC authorities and is currently in draft form. To enhance the competitiveness of the IFSC authorities had set up an expert committee to examine the Singapore VCC structure and suggest a framework for the IFSC. The committee submitted its report in May last year, suggesting the VCC structure in IFSC. A VCC structure for the IFSC would be a hybrid structure which combines the advantage of a trust, LLP, and company while dispensing with some of their key limitations. The structure and the mechanics of the proposed VCC are quite similar to some of the popular structures around the world, such as the VCCs in Singapore open-ended investment companies in UK and open-ended fund companies in Hong Kong. The most important feature of a VCC is that it would be an umbrella fund, sub-fund kind of a structure, which would be permissible, wherein each sub-fund is proposed to have a separate legal entity with the ability to contract, hold property, ability to sue and be sued, and other features of a corporate entity. Assets and liabilities of one sub-fund will be ring-fenced from the assets and liabilities of the other sub-fund. Separate financial statements and separate scheme documents will have to be prepared for each sub-fund. Another key feature of a VCC is that it would have a variable share capital, wherein it is permissible to pay dividends even out of capital. Having said that, we will probably have to wait for some time before the VCC regulations will be brought into law. With that, let's go on to our polling question, the first polling question for the day. The question is, what is your investment strategy for India? And we welcome all of you to share some thoughts. The first answer is, we are fully invested and have no further plans to invest. The second one is likely to make strategic portfolio investments under FDI, FPI route. The third answer is likely to invest in AIFs in mainland India. The fourth one is likely to invest in a fund in IFSC. And the fifth one is don't know or not applicable. And while you answer the questions, for the uninitiated, FDI or the foreign direct investment route is a route used for making strategic investments in joint ventures or subsidiaries in India, both listed as well as unlisted. And the FPI or the foreign portfolio investment route is a route under which listed investments can be made after obtaining a license from a custodial bank. Foreign investors, especially private equity funds, have also commonly used the AIF route for investing into India, especially in debt securities. Let's see what our answers are here in the meantime. Okay, so we have a fairly even distribution with surprisingly, out of the first four answers, even 15 to 16% or double of the earlier three answers have said that they are likely to invest in a fund in the IFSC, which is quite encouraging. About 8% have said that they are likely to invest in AIF in mainland India, and similar percentage for the first and the second answer. So the fact that there is a significant interest in setting up an IFSC fund seems to be quite encouraging over here. So with that, thank you for listening to me, and this brings an end to my discussion on asset management, and I would like to hand this over to Madhav.
Thank you, Rajesh, and good morning, everyone. I'll be using the next 10 minutes or so to provide an update and overview on recent scrutiny audit trends in India, especially insofar as they relate to the private equity and venture capital fund industry. As you would know, global funds that have an India nexus or receive income from their Indian investments are required to file income tax returns in India. These returns may be selected for scrutiny audits by the Indian revenue authorities based on parameters established by the Central Board of Direct Taxes, which is the administrative body of the revenue in India, from time to time. Last week, incidentally, the CBDT has issued its latest guidance for compulsory selection of cases during the current financial year 2022-23. Parameters listed by the CBDT include cases where specific information has been received from any law enforcement agency relating to tax evasion particularly, and cases involving additions in earlier financial years on recurring issues. Additionally, if income is considered to have escaped assessment, you might know that cases could also be reopened within 3 years from the end of the relevant assessment year if the income escaping assessment is less than approximately $65,000 or up to 10 years from the end of the relevant assessment year, where income escaping assessment is about 65,000 is more than $65,000. This extended window of 10 years was introduced under the garb of reducing the reassessment window from 6 years to 3 years, but that's the provision in the law currently. Moreover, the procedure for initiating reassessments also underwent a change with effect from April 1, 2021, which coincided with extensions given to the old procedure due to the pandemic. This caused confusion on which procedure is correct and applicable, but the Indian Supreme Court has recently directed that procedural infirmities due to the transition process in the reassessment procedure ought not to disentitle the Indian revenue from pursuing the reassessments. In light of this ruling, the CBDT has issued guidance last week to its officers for them to continue with the reassessments. A recent development that the private equity and venture capital fund industry might particularly be tracking is the issuance of some orders recently in the case of Mauritius, Singapore and Cyprus funds, denying access to the applicable tax treaty after evaluating the relevant facts in detail, and the selection of several other funds for a similar scrutiny, which scrutinies are currently underway and the outcome will be known over the next few months. The revenue is essentially probing whether funds from these jurisdictions have underreported their income by misusing the tax treaties with Mauritius, Singapore or Cyprus as the case may be, as these treaties provide for capital gains tax exemption, particularly a grandfathering for pre-2017 equity investments insofar as Mauritius and Singapore are concerned. They continue to treat capital gains from non-equity investments to not be taxable in India, and also provide beneficial tax rates for dividend and interest income. During the course of these scrutiny audits, the Indian revenue authorities have sought details of qualifications of each of the directors, particularly the non-administrator directors, other positions held by such directors within the fund group, the nature and extent of their actual participation in the decision-making of the fund's activities, formally as members, possibly members of the board of the fund, and as well as any additional involvement that they may have as part of the group. The extent of information available or reviewed by these directors to arrive at the decision. They've tried to determine who has the actual control over the bank account operations and several such factors to essentially come to a determination on where the place of effective management of the relevant entity claiming the treaty is. Is it in the country of incorporation or is it elsewhere? The Indian Revenue has surprisingly also looked at where the actual investors in the funds hailed from and what would have been the taxing outcome if the investors had directly invested in India. Obviously, one goes through a fund for several reasons beyond tax reasons, but this is also a parameter that the Indian Revenue has evaluated. Wherever possible, though we understand that the Revenue has therefore attempted to establish that the taxpayer does not have commercial business activities and or economic presence in the country of incorporation. One cannot help but notice the similarity in this latest approach of the Indian Revenue with observations that the Authority for Advanced Rulings has made in the cases of AB Mauritius and Tiger Global. Tiger Global was an indirect transfer case, but there were some observations on treaty eligibility. And the decision of the Bombay High Court in the case of Aditya Birla Nuvo. Incidentally, the writ petition filed by Tiger Global came up for hearing during the course of last week, but was adjourned. Overall, the Indian Revenue Authorities believe that Circular 789, which essentially validates tax residency based on a tax residency certificate and is binding on the Indian Revenue, and the Indian Supreme Court ruling in the case of Azadi Bachao Andolan, which is the law of the land insofar as granting treaty benefits is concerned, they believe that these two guidances cannot be applied in cases where the substance of the fund structure is not congruent to the form of the fund structure. And they believe that they have better information to be able to establish these aspects in the course of scrutiny audits in select cases, depending on the facts. News reports, in fact, suggest that tax demands of approximately $65 million have been raised on private equity and venture capital funds as a result of this recent development and examination by the Indian Revenue. And obviously, fund houses are, in response, re-examining their structures in light of the recent developments, both the structures in the past as well as the structure that exists today. Evaluating whether insurance covers would be a good alternative, and assessing if a provision is required in their books for existing or probable tax liabilities. Moreover, if any notices or orders have already been received, then fund houses are evaluating the indemnity, warranty, or clawback provisions for transactions that have already been concluded in the past, And ongoing and impending transactions are equally affected in terms of indemnity and warranty provisions that are being negotiated, the period for which these provisions should run, the strength of the tax opinions that are being provided or procured, whether a withholding should be undertaken on a conservative basis, or should alternatively a withholding certificate be procured from the Indian revenue, and so on and so forth. Finally, in cases where notices or orders have been received, reliance placed on buyers on the Section 281 certificates, which essentially are provided as part of transactions to indicate that the transfers would not be considered to be null and void, could also be impacted if there are ongoing assessments. We'll have to obviously wait and see how this issue progresses through the appellate process. A news report suggests that most affected funds have approached the dispute resolution panel in order to be able to approach the income tax appellate tribunal in a timely manner, because that's a more time-bound process. But some funds have also chosen to approach the Commissioner of Income Tax Appeals. On the next slide, I've represented some of the salient information that the Indian Revenue sought during the course of these scrutiny audits. This information is available for your reference in the slide deck. I'll, in the meanwhile, move on to the next slide, where I've listed some other issues that the Indian revenue authorities have been probing into recently and which might be relevant to the fund industry. These are issues that may not necessarily have reached adverse conclusions as yet, but are being evaluated actively by the Indian revenue, and therefore we thought it important to highlight them. The first issue pertains to partial reading of the law, where a taxpayer essentially relies on the provisions of both the applicable tax treaty as well as the Indian Income Tax Act for the same financial year. Certain taxpayers have filed their income tax return in India under the provisions of the respective tax treaty, but applied provisions of the Indian Income Tax Act to the extent that they were more beneficial, especially where they had incurred capital losses that they sought to carry forward to future years to optimize the tax liability in subsequent years. The Indian Revenue has been looking into these positions, and therefore one must be careful in the manner in which these positions are represented in the original tax return, the manner in which these positions are represented in a subsequent tax return where the brought forward losses are sought to be utilized, and how these are disclosed to the Indian Revenue, possibly by way of notes to tax returns. The next issue relates to whether a non-resident taxpayer could claim tax treaty relief on its gross capital gains without setting off brought forward capital losses where it is choosing to apply the treaty while filing its return, or whether taxpayers would need to claim only the net capital gains, that is after adjusting the brought forward losses, as not liable to tax. Indian courts have recently looked into this issue and issued a couple of rulings that the gross capital gain is essentially the gain that is not taxable in India for that particular year, and therefore is not to be considered to be part of the taxpayer's total income at all. In which case there is no question of setting off the brought forward capital losses against such income, and taxpayers could rely on these rulings, but will need to track this issue as it goes further in appeal by the Indian Revenue. The next issue relates to, you may be aware that the Indian Income Tax Act provides the mechanism for computing capital gains or losses after considering indexation of foreign exchange fluctuation benefits, particularly while computing capital gains on transfers of unlisted shares by non-residents. However, if the concessional tax rate of 10% is to apply, then taxpayers are neither entitled to the indexation benefit nor entitled to the foreign exchange fluctuation benefit. Some taxpayers had taken the position that this encumbrance only applies if there is a positive capital gain, but if there were to be a loss, then indexation or foreign exchange fluctuation benefits could be applied on the basis that the rate of tax is not to be availed in the context of a negative capital gain at all. Again, this is a position that has the Indian Revenue is aware of the fact that these positions have been taken, and officers are looking into that position to come to a determination of whether they agree with this position or not. With that, I'd like to move to the second polling question of the day. The question essentially is in line with what we just discussed as to what has been your recent experience with scrutiny audits in India. We'd like to request you to choose from the following options. That detailed questionnaires were issued with, with a lot of communication and conversation with the tax office, and which resulted in proposed adjustments. The second option is, while there were detailed questionnaires, the returned income was eventually accepted. The third option is audit was not particularly detailed. The fourth option is no audits were recently conducted. And the fifth option is don't know or not applicable. While we wait for your responses to come in, experiences might be different depending on the nature of the taxpayer undergoing a scrutiny audit. For example, Indian companies that are undergoing scrutiny audits under the faceless scheme tend to receive much more detailed questionnaires because the revenue would like to ensure that they have covered all aspects of the scrutiny audit. Some of the foreign taxpayers where there are large claims that the revenue are actively evaluating also similarly receive detailed questionnaires. But some of the other taxpayers where no material issues are involved may experience that scrutiny audits are in fact becoming simpler. We have the poll results on the screen, and not surprisingly, about 28% of the audience feels that detailed questionnaires along with proposed adjustments is the trend that they have recently encountered. But equally, there are 20% of the audience for whom no audits have been recently conducted, which again, which is heartening to see insofar as those taxpayers are concerned. But that's been the trend overall. With that, I'd like to hand over to Beros to continue the discussion on the insurance sector. Thank you.
Thanks, Madhav. Good afternoon to all, and thank you all for joining this session. So we'll be discussing today on some developments in the insurance and reinsurance sector. We can go to the next slide, please. Insurance has been the youngest subsector within financial services as far as private insurance companies are concerned. And it's the most unpenetrated sector, if you look at it from that perspective of financial services. Rajesh and Russell have been speaking about IFSC. And IFSC actually has become a buzzword now, and it's actually transformational for financial services sector, because we're seeing a lot of business being set up over there, post the IFSC authorities being coming into place. They have come out with two regulations, the insurance intermediary regulations and the setting up of the insurance registration office in IFSC. They came out with draft regulations first to start with, asked for comments. Even we provided certain comments, and then the regulations have been formed. And the regulations do provide for a lot of reliefs from a regulatory perspective, say capital requirements, solvency requirements, business activities that can be done by a particular insurance company in IFSC. So there are clearly certain arbitrages as compared to mainland India and IFSC. When we look at IFSC, we need to look at the tax aspect also, which is very important. Russell mentioned and Rajesh also mentioned about tax holiday being there. So the insurance companies will get a tax holiday if they're set up over there in the IFSC. And what happens when you have losses in your mainland? And we've seen insurance a long gestation period. Therefore, we've seen some companies still having losses in mainland India, and you have gains in the units of the IFSC. Would you get tax holiday on those gains? And can you carry forward the losses in the mainland India entities? Based on judicial precedents, based on other tax holiday wordings that are there in the provisions, let's say ATIA or Section 10AA, a claim could be made, but of course it can involve litigation. The next question that has to be looked into is MAT provisions. Would MAT be applicable at the unit, or would it be applicable at the entity level? That needs to be discussed and deliberated on, and to take a position on that. Further, what we need to see is Pillar 2, the OECD Pillar 2, when it's coming into effect. What will happen to these tax exemptions and tax holidays which are there? We look at the other regulatory changes which have come about. We had the largest capital markets IPO, LIC, Life Insurance Corporation of India, one of the oldest insurance companies in India, had its IPO. It's listed today, and unfortunately the shares have actually listed at a discount to the issue price, which we've always seen that when it's an exit by investors, the price is very high, and at sometimes post-listing also the price falls. But what we have seen is there are already 3 other life insurance companies which are listed: HDFC Life, SBI Life, ICICI Pru, and 3 non-life. 2 of that is a PSU non-life and 1 ICICI Lombard which are listed. And we're expecting much more IPOs to come in during the year. If we look at the FDI limit was increased from 49% to 74%. And we need to look at the tax implications. Of course, there are certain safeguards that they have mentioned on control, on directorship, on repatriation of profits which are there. But what we need to look at it from a tax perspective is Section 79 getting attracted because of change of shareholding. There's a section which requires the shareholding to be continued if you need to carry forward losses. And that section has to be looked into. Second is Section 56(2). Can you say that the issue of shares, if it's done at the value below the fair market value, would give rise to an income? So that needs to be looked into also. Valuation of shares is very important. So with the regulatory changes, the tax implications also have to be looked into. What we are seeing is IRDA is now proposing that they will ease the process of registration of insurance companies in India. In the past few years, what we have noticed is that private equity companies, private equity funds have started making investment in insurance companies. And also further, we've got just around 58 insurance companies in India as compared to, say, Singapore, where there are around 211 insurance companies. So if you look at the ratio, India is quite less as compared to Singapore, other countries which are there. Therefore, IRD also has been seeing that how we can give more relief, reduce the documentations, simplify things, and give a registration which is much faster. Can we go to the next slide? And of course, whenever you look at registration, you need to look at how do you structure the investment into India. Next, we are going to talk about the taxation developments. And before we come to the developments, just slide very briefly and very simplistically on how insurance companies are taxed in India. We have a specific code, Section 44 of the Income Tax Act and the first schedule to the Income Tax Act. 44 says it's notwithstanding anything which is contained in other provisions of the Act, specifically for capital gains, income, other sources, business income, everything will be computed as per the first schedule. So your profits are computed as per the first schedule. If it's life insurance company, it's actuarial surplus as per the first schedule, which is taxed. If it's a non-life insurance company, it is a profits as per books of accounts, plus specific adjustments which have to be done. And they have listed those adjustments in Rule 5 of the first schedule. Only that has to be done. So it's very clearly provided as to how it has to be computed. And the life insurance companies are taxed at the lower rate of tax of 12.5% plus surcharge and cess. General insurance companies are taxed at the rate of 30%, or now we have the lower rate of tax of 22% plus surcharge and cess. If you go under the lower rate of tax, MAT is not applicable for general insurance companies. MAT was anyway not applicable for life insurance companies. The issue which comes in life insurance, and there are several issues in litigations, not just one of them, but mainly on the actual surplus, whether it takes into account the policyholders' funds, the income on policyholder account, or also income on shareholder account. Judicial proceedings till date has said that it should be both combined together. Income on policyholders account and shareholders account need to be taxed together as actual surplus. The matter is pending before the Supreme Court. In case of reinsurance companies, generally we've seen that reinsurance companies are taxed as non-life insurance companies, unless we've seen specifically branches where it's only life. However, we need to discuss and debate on or make a position on that as to can we claim separate businesses according to the computation that's been provided in first schedule and the rate of tax on that, business-wise. Can we go to the next slide, please? Basically, on policyholders' taxation, there were certain amendments made whereby income earned on the unit-linked insurance policies is now become taxable from 1st of February 2021 if the premium paid is more than 250,000 rupees. The act has been enacted. The rules for the same were issued subsequently. And the rules and the guidance which has been issued by CBDT actually provide for certain reliefs. So whenever you're looking at the taxation, whether it's on withholding tax or not, the rules should be looked into because there they have deemed it to be capital gains arising on equity-oriented funds. So you need to look at the rules when you're computing the taxability on income arising from ULIP. During COVID, IRDA came out with a circular which says that you could pay the ULIP maturity if it's maturing within that period of COVID times in installments. Now the question arises is it taxable on accrual when it's matured, or should it be taxable on receipts whenever those ULIPs are being redeemed and paid? It should actually go on receipt basis because you did continue to hold the units of the ULIPs and then you got maturity amounts coming. However, if the clarification would have been issued on that, that would have helped. Transfer pricing considerations, we've seen that in the past, we've always known banking had huge transfer pricing adjustments. Now what we are finding is that there have been adjustments in the transfer pricing for insurance companies. Basically, what they're looking at is documentation, a much robust documentation for head office expenses allocations, centralized cost allocations, and now what we're looking at is brand. Brand has still not been disputed, but it's something which insurance companies in India are now seeing whether they can make brand payments. In case of HO and centralized support services, what we are looking at is basically to say that you should satisfy the benefit test. Benefits have been received by the Indian company should be documented. Allocation keys should be documented. It should not be something that only expenses have got charged to India, but it's charged across countries. And the third aspect is documentary evidence of services being provided. They are looking into all of that. It's not only a policy document, but actual services have been provided, has to be documented and proved. When we look at the risk of P because of COVID and work from various locations in that manner, we've seen much more analysis being done, including by insurance companies, because of the service P clauses that are there in the India treaties and agency P clauses which are there. So depending on the activities of the individuals who may be posted to India or activities by the Indian companies, analysis are being done on whether PE is being created or not. And of course, we should not forget the immigration laws also. One more aspect that we've seen in some of the audits that have happened, and specifically of maybe of reinsurance company branches in India, ratio of claim settlement to premium ceded. And we all know in retrocessions, most of the insurance companies cede premium to reinsurance companies outside India. What the tax authorities are seeing is they're asking for documentary proofs to show that if supposing I had 1,000 of premium ceded, I can't have a claim settlement from the same party to the effect of 5 rupees. It should be comparable, it should be benchmarked, and therefore this is something where documentation proof is required. When we look at the other tax updates on non-corporate taxations, non-life company taxation, one is there's a TDS provision in section 194D which says that you need to withhold tax when you make a payment to resident of commissions, insurance commission. There's been a debate going on for this. There are judicial precedents on it to say reinsurance commission, there should be no withholding of tax because it doesn't fit within the definition of commission under section 194D. This particular tribunal decision, which is an interim relief, it's not a final decision, it's an interim relief, but it's to a non-resident. So here the petitioner is a non-resident who was asked to deduct tax under section 194 when it's making payment to a resident and for reinsurance commission paid. So this has to be seen what the final outcome comes about it. But this is something which is very interesting that even a non-resident was challenged on whether it should deduct tax or not. And therefore whether it can get a deduction under section 40A1 or a disallowance under section 40A1. The next tribunal decision, this has been an issue which has been going on. Reinsurance payments made to non-resident reinsurance companies. The question arises is that, and this has been started from Chennai. So the Chennai tax authorities and Chennai tribunal also said that reinsurance premium paid to non-resident reinsurance companies are illegal post 2014. And therefore they should not be allowed in view of explanation 1 to section 37. Then they also took an alternative argument and said that since tax has not been deducted at source, these amounts are disallowable. The petitioner actually went to the High Court, Chennai High Court, and there they have even taken IRDA as an intervener as a respondent to this case. And they have then, the High Court has held that no, the payment made to non-resident is not illegal. It's permissible under the Insurance Act, and therefore it should be allowed as a deduction. With regards to withholding tax, they have set aside to say you examine it and see whether it's disallowed or not. The same issue has now come to Mumbai. Mumbai tax authorities followed Chennai, and what they have done is they have tried to disallow reinsurance premium on the same grounds. The Mumbai tribunal here has examined the Chennai High Court, examined circulars which are there, the old circulars of 56 and all of that, and then come to a conclusion that the payment made is not illegal transaction. It is allowed under the Insurance Act. If you're aware, you need to give a reinsurance program every year to the IRDA. and IRD approves of that. When IRD has approved the reinsurance program, which allows you to reinsure with the non-resident reinsurance companies, how can that be illegal transaction? So tribunal very clearly said it's not an illegal transaction. They also allowed on the ground that disallowance under 40A1 should not be applicable because tax is not required to be withheld at source as the non-residents lacks P in India. And this is a good tribunal decision. The next main issue is on this disallowance under section 30 to 43B. In case of non-life, I mentioned there are specific adjustments that need to be done. And those adjustments, if you look at it, one of the adjustment is expenses allowance inadmissible under section 30 to 43B, which is a business income computation. Now the question arises that you could have a disallowance because of say 43B, a timing difference, disallowed when the expense is incurred, allowable on payment basis under 43B, or disallowed when tax is not deducted at source, but allowed in the year when tax is deducted at source under 40A, or disallowed because it's contingent expenses, allowable on reversal of those expenses or actual expenses incurred. There was no such thing on allowance of it. So the Finance Act actually amended this rule and said that if you make payment under 43B, it should be allowed. But they only spoke of 43B. What happens to other types of expenses? So this tribunal actually said that if something is inadmissible under 30 to 43B, as a natural corollary, those amounts which are otherwise allowable will get covered. And therefore, this is a very helpful decision. There was a lot of question on depreciation also which used to come in, but now this has got covered. And this would help us in IFRS 17 when it gets implemented. The next is an unrealized risk reserve and premium deficiency reserve when you're computing MAT. May not be relevant because most insurance companies now don't go under MAT unless they have MAT credit to be carried forward. But assessing officers are trying to say these are provisions for uncertain liabilities. At DRP and CIT appeal stages, this should be allowable as normal provisions for insurance companies. Next, we now cover basically to say what is the OECD Pillar 1 and Pillar 2. The OECD has come out with Pillar 1, which we are aware of, to say it is MNEs with a global turnover of 20 billion euros. And this is very important. What they are now saying is that income has to be attributed to where the market is. India is generally a market it's a buyer. We buy a lot of goods digitally. And therefore, some income needs to be attributed to where the market is. Not only where the manufacturing happens, not only where the risk is there, not only where capital is involved, but also where the market is involved. And they have come out with certain formulas for it. We need to see how this is going to be implemented in India. But today we already have an equalization levy. And therefore we need to see whether equalization levy applies to non-resident companies who have transactions digitally with, say, a resident Indian or a person who has an IP address of India. And this is very important. I could be anywhere around the world having an IP of India. And therefore I need to cover that. And also on non-residents. We need to evaluate this to say how equalization levy will come. It has expanded scope of online sale and goods and services. If you go to the next slide, please. OECD Pillar 2, and this is something which keeps coming up, is that every company should pay a minimum amount of tax. And they have laid out rules, they have given examples, they have given guidance on how it has to be done. We still have to see how this gets implemented in India. The minimum rate of tax which every jurisdiction could look at is 15% is what they have indicated. If you look at India, 15%, life insurance companies anyway is 12.5. It will come to plus surcharges may come near to 15. Non-life anyway is much higher than that. Only question will come is if I take a tax holiday and then I look at the rate. If it goes below 15, what happens then? Whether it will get captured in some carve-outs or exceptions, if you've set up before a particular timeline, needs to be seen. So basically, OECD Pillar 2 is something which needs to be evaluated. And one more point in that is that they have tried to keep shareholders' profit separate from policyholders' profit. How that will be implemented in India, where we are taking the two together, has to be seen. If we now look at the polling question for insurance, if you go to the polling question, basically, would India implement Pillar 2? And if yes, I think it should be implemented. It will be effect from which date? Whether it's 1st April 2023? Because globally, if you look at it, they have said that you should bring in the laws in 2022 and should be effective from 23. Or whether it will be effective from April 24, April 25, or not to be implemented. I don't know, not applicable. So I request all the participants to please take this polling question and give your response to it and your inputs to it until we wait for the polls to be coming. Basically, if you look at it, in the income tax law, for certain entities which have been set up in IFSC, they have given a sunset clause. if you have set up by 31st March 2024, you will be eligible for deductions for the tax holidays, for the exemptions which have been created. So does it mean that the government is seeing 31st March 2024 as the sunset clause for tax holidays? It's not come in the section as yet. It's come in some of the exemptions which are there. So that needs to be looked in. Can we have the poll? 23% have said it's with effect from 1st April 24. 16 wants it from 25 and 14 wants it from 23. That's very good. Not to implement is going to be difficult. And we don't know, not applicable could be. So we are through with our thing, and we just hope that government now looks at things and provides clarity when they're coming out with IFSC tax holidays, or whether it's OECD Pillar 1 and Pillar 2, or IFRS 17 if it gets implemented in India from 23. Hope government comes out with clarifications and discussions on this before the amendments. Thank you, and over to you, Russell.
Thank you, Behrouz. I think we have time for taking a few questions. I think the first question that we've received from the audience is on private equity audits. So I'm going to direct of the eventual outcome of these adverse scrutiny audits where tax treaty benefits have been denied in the context of grandfather investments.
Thanks, Russell. I think that's a bit of a tricky one to call. If the appellate process essentially sort of continues to rely on the technical guidance of Circular 789 and Azadi Bacha and the grandfathering provided in the treaty, then it should be straightforward that in appeal there should be some favorable outcomes. But if the revenue is able to, on a case-by-case basis, convince the appellate authorities that it needs to be looked at in a different manner, then it will go down to the strength of the facts of the case.
Okay. Thanks for clarifying that. I think the next question that we've got is on GIFT City and asset management. So I'm going to ask Rajesh this question. Rajesh, what is the substance requirement for a fund manager in the GIFT City?
All right, that's an interesting question, Russell. So in the draft regulations, before the regulations were finalized, there were a host of conditions which were surprisingly removed in the final regulations. So these conditions said that the fund management entity should have adequate personnel exercising control or influence over the management of the portfolio sitting in the IFSC, and it should undertake key management and commercial decisions relating to trade and the trade execution necessary for the conduct of the business in the IFSC. Now, both of these conditions have been removed when the regulations were enacted, and the only condition which remains is that the proposal for the portfolio composition, how the portfolio should comprise, should be initiated by a person who is based out of the office of the fund management entity in the IFSC, which means all what the authorities are asking is that the portfolio setup should be initiated by a person who's sitting there, but the trade execution and some of the other functions can be based outside the IFSC. So pretty much relaxed in terms of the substance requirements from a regulatory perspective, but at the same time, I would also be careful that I should not trip the test from a tax perspective, and one needs to therefore ensure that there is adequate substance commensurate with the type of activity which the fund management entity does in the IFSC.
Okay. Thanks, Rajesh. And quickly, we'll take one question on insurance. So Behrouz, I know we're a little over time, but if you can just keep this brief. The question is a fairly simple one. It's have you seen insurance company pay equalization levy in India?
So presently, we've not seen non-resident insurance companies pay equalization levy, but what we've seen is there have been analysis done, and it's somewhere come out that the vendor could be liable to the equalization levy as compared to the insurance company, because they do have vendor relationship alliances which they have. Based on that, the vendors have done the payment.
Okay. Thank you, Behrouz. I think this brings us to the end of today's session. It has been a really interactive one. Rajesh, Madhav, Behrouz, thank you. And a special thanks to all our audience members who joined us today. We encourage you to fill out the webcast survey and tell us what you think about today's program. This presentation will be archived for future viewing. We will respond to all questions submitted during the webcast in a couple of weeks. And please do not forget to tune in to our next webcast, which is scheduled for May 26th and is titled Financial Services Series, Tax Developments in Australia. From all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye and have a nice day.